In a surprising twist, HDFC Bank, one of India's leading private financial institutions, has released remarkable profit figures that have surpassed analysts' expectations for the second quarter. This news, shared on Saturday, highlights the bank's steady loan growth and increased trading revenue despite a dip in lending margins that could concern some investors. For the 3-month period ending in September, HDFC Bank posted a standalone net profit of 186.4 billion Indian rupees, which is approximately $2.12 billion. This figure represents a significant increase from the 168.21 billion rupees reported during the same period last year, demonstrating the bank's ability to perform well in a competitive environment. Analysts had anticipated the bank would report a profit closer to 177.18 billion rupees. According to the data compiled by LSEG, marking a notable achievement for HDFC. The bank's net interest income also saw a rise, climbing 4.8% to reach 315.5 billion rupees. However, it's essential to note that the net interest margin, which is a key indicator of a bank's profitability, decreased slightly to 3.27% from 3.35% in the previous quarter, raising questions about how banks manage changes in interest rates. Typically, when benchmark policy rates decline, banks tend to adjust their loan interest rates more quickly than those for deposits, leading to this margin contraction. Looking ahead, HDFC Bank's Chief Financial Officer, Srinivasan Vaidyanathan, expressed a positive outlook, predicting that margins are expected to improve in the coming quarters as deposit rates adjust. The net trading income and mark-to-market gains for the quarter were impressive as well, reaching 23.9 billion rupees compared to just 2.9 billion rupees from the same quarter a year prior. The bank enjoyed a notable loan growth of 9.9% year-over-year, primarily driven by an upswing in lending to small and medium-sized enterprises. Following its merger with its parent company, HDFC, 2 years ago, the bank has been diligently building its deposit base, which also saw a healthy year-on-year growth of 12% during this quarter. In recent months, there has been a gradual resurgence in credit demand across Indian banks after experiencing a slowdown over several quarters. Many analysts are optimistic that this momentum will continue to strengthen in the latter half of the fiscal year, particularly as recent tax cuts have stimulated economic activity. Sashidhar Jagdishan, Chief Executive Officer of HDFC Bank, noted that the increased economic activity following tax reforms is clearly reflected in the bank's robust loan growth for the quarter ending in September. He further indicated that HDFC Bank aims to align its loan growth with that of the overall banking sector for the current fiscal year and expects an even faster growth rate in the next year. In terms of asset quality, the Mumbai-based lender has reported improvements, with its gross non-performing asset (NPA) ratio declining to 1.24% at the end of September from 1.4% just 3 months prior. Additionally, the provisions set aside for potential bad loans and unforeseen losses surged 29.6% year-on-year to reach 35 billion rupees. This indicates the bank's cautious approach to managing future risks, particularly in light of tightened underwriting practices and increasing loan loss provisions prompted by stress in retail segments, including personal loans and credit cards. As HDFC Bank forges ahead, the contrasting narrative of impressive profits against the backdrop of weakening margins raises intriguing questions. Will the bank's strategies to improve margins be successful in the coming quarters? And how will the ongoing economic changes impact lending practices across India? We invite you to share your thoughts below. Do you believe HDFC Bank can maintain its growth trajectory amid these challenges?